hope you had a great break. Please, people who are standing in the back, move up front. We have a lot of seats up front. We have a great session coming up. I just want to ask you a quick question. I know a lot of you heard about software as a service. Have any of you heard about capital as a service? Doesn't seem like one person? Two? Okay. Well, I hope after this session you have a little bit more clarity on what it is and how to apply it. We have two amazing experts joining us. Ashley Carroll, she's a partner at Social Capital. She's focusing on early stage investing as well as leading a capital as a service initiative at Social Capital. And we have Josh Constine, editor-at-large at TechCrunch. He's a technology journalist, has moderated over 100 on-stage interviews in 13 different countries, talking about international. And those are the leaders that include Facebook CEO Mark Zuckerberg, whistleblower Edward Snowden, Tim Cook, and many others. And last but not least, he also developed a master's program at Stanford in cyber sociology. So a lot of exciting things to talk about. And let's just give them a round of applause and put them on stage. Josh and Ashley.
Hey everybody, thank you guys so much for coming out. We're really excited to get to do this session. You know, there's been so much talk lately about dumb money in venture capital. There's just been this massive explosion of interest, especially in the seed fund stage, of all sorts of people from the private equity world, the hedge fund world, oligarchs from around the world, pouring capital into the startup ecosystem. And some people actually think that that's a problem, that if there's so much dumb money, it's getting spread between all these companies, bad ideas are getting funded, and what that means is you get bad companies recruiting talent and dispersing that talent, rather than getting a whole lot of smart people in the same room to be able to solve really big challenges. And so I'm excited to get to talk with Ashley about this today because she's really doing something about it. So you've talked a lot about how while there is all this capital, we haven't really necessarily seen a meaningful improvement in addressing really large world-scale problems. So maybe you could just explain your perspective on why more money, why there actually isn't enough money right now in the Silicon Valley startup scene.
Yeah. So I think from a VC perspective, a lot of people around here will make comments like, oh, there's so much money in the ecosystem, so many every day you hear about new funds, etc., which is true. And within this ecosystem, as well as New York City, LA to a lesser extent, I mean, for all else equal, we will be paying a lot higher valuations for companies now because it is more competitive. And so there are more dollars coming into the system, like that's just the data, but they're all focused on these same little microcosms: San Francisco, Silicon Valley, New York, LA, maybe Boston. And so there's a lot of rhetoric around there's too much money, there's too many VC dollars, but at the same time, I see so many entrepreneurs, particularly entrepreneurs outside of this area, and even within this area, particularly female and minority entrepreneurs, who are working on really real large problems, have built real businesses, yet struggle to fundraise. And for that reason, I say there still isn't enough capital because there are great businesses all over the world that are not able to raise venture capital.
Yeah, I feel like both Founders Embassy and Social Capital's Capital as a Service have a similar idea that not every great founder is going to look like the last crop of big CEOs. Just because some guy's white and went to an Ivy League school, that shouldn't be how you get capital. It should be because you have a great idea. And both of us have the good fortune of going to Stanford, but I think both of us also want to see more people from much more diverse backgrounds being able to get access to this capital. And so 7 months ago, Social Capital revealed its Capital as a Service program, which lets entrepreneurs apply for typically $50,000 to $250,000 investments that are done by a software-driven quantitative due diligence program. So instead of just meeting with traditional VCs, over a boardroom table, or instead you actually apply online. The firm looks at your metrics, how you've been doing, and then can assess straight from there whether you're worthy of capital. So maybe you could just tell us a little bit about how this works and how this is filling in a gap for Silicon Valley.
Yeah. So first of all, I guess backing up one mini step as to how we sort of came up with this idea to begin with. So social capital is a lot of data-driven, former operator people across the entire firm, myself included. And so we have and have had for years, a very robust quantitative diligence part of our decision-making process. But until the last year, it was mostly done by humans. And so investors like me would meet the companies, and then we would pull in a data scientist to kind of do a very in-depth analysis of not just financials, but more engagement. And we believe that we can detect product market fit very, very early as a result of our process, which has resulted in quite a large benchmark data set. So capital as a service is really just the productization of that process, which allows us to open it up to a lot more people. So before, you used to have to, come meet someone like me in person, and then maybe meet one of my partners, and then come in for a partner meeting, and then we would, kind of make assessments around, we'd know a little bit about the business, obviously. We'd make assessments around the team and the market, and then after all of that was done, we would engage in the quantitative diligence. And so what this does is it really pulls that out, and that is the front door. And so, A, it opens it up to a lot more companies in terms of, larger N, but B, it takes away the requirement of needing a warm introduction. Because as humans, we are just overwhelmed with, cold emails and stuff like that. So that's why everyone says, oh, you need a warm intro to get a VC meeting. It's just because humans don't scale, whereas software does. As for how it works, it is basically a web-based application. There's a more qualitative, like structured data portion. We use that to categorize the company. So, this company is a B2C freemium subscription weekly use case business, something like that, but the ontology is actually quite complex. And then based on that classification, we will look at different cuts of engagement and or transaction data and compare it to benchmarks and make investment decisions based on how they stack up to all the other companies we've seen.
So this is really part of this massive trend I've been seeing, this kind of post-intuition era for venture capital, where firms are increasingly building their own software stack to be able to vet startups. And that doesn't just mean looking at what's publicly available, but also in some cases pulling in lots of really interesting private data sets. I know one firm called Signalfire has been doing stuff like they're finding credit card data, they're figuring out who is spending money where. They've also built like a massive map of all the engineers in the world and when they're going to be leaving their jobs and predicting when they should get poached by their portfolio companies. And not only are these firms using the data to be able to vet and select which startups to fund, but also to help these companies afterwards. So where does social capital sit on that end of the spectrum? Is this technology really just for vetting the startups, or are you guys helping them do market analysis and strategic planning as well?
Yeah, so capital as a service was, like most new products, some like internal name that just sort of stuck. And V1 was really, can we find decent, identify good companies and convince them to, take money in this fashion. But the other half of it is just as important, because it can't be just capital as a service, then you kind of fall into the dumb money category. And it is very much the same analysis that we use for diligence. Companies find really helpful. So for example, there was a company that was coming back and applying every single month, and we were kind of like, what's going on? Like, do you need more capital every month? And
I like that go-getterism.
Yeah, admirable. And the CEO said, oh, no, we don't need company, we just want the analysis. And so we are in the process of building out the more, today's application is sort of the unauthenticated experience from a product perspective, and we'll be working on the more authenticated, logged in, founder platform going forward. But a lot of our guidance, and we do this with our, more traditionally funded portfolio companies as well. We have an entire platform team that does a combination of both product and services, and pretty much everything is rooted in data. So we help with marketing acquisition, understanding engagement, benchmarking type analyses, stuff like that.
That seems really important, especially as there's just been this massive proliferation of thought leadership in Silicon Valley, where basically every fund is competing to show off how smart they are with series of blog posts and tweet storms, speaking at events, trying to show that they really know what they're talking about. But a lot of times it's like, I can get that anywhere. A lot of times I might even be able to get that for free. So I'm really fascinated to see how venture firms are going to start adopting more of this software, stuff that the portfolio companies really feel like is going to give them an edge. But the one thing I'm a little bit confused about is that one of the most important factors in whether a startup succeeds is the grit of the founders. That's that willingness to grit it out through those tough times, when the darkest days hit your startup, when, a big hire declines, a big executive leaves, a product partnership falls through, or a product launch, the schedule slips. It can be really tough, and I know a lot of founders want to cry, and we need to be able to embrace the toughness of the mental health of being a founder. But you have to be able to assess that grit to be able to really choose great startups. And that's pretty tough to do qualitatively.
Yeah.
So how do you guys assess qualitatively the grit of a founder if you're doing so much of this through software?
So with capital as a service, we're not currently assessing that. And
that seems like a big risk.
Yes and no. I don't think that my ability to, have coffee across from someone and, with my own gut and intuition determine how gritty they are or various other attributes. I actually would never claim that I would be, that would produce better outcomes than looking at data. So the short answer is we're not using it today.
That surprises me, because honestly, I met you like a decade ago at school, and I didn't know very much about your academic background, but you just had that attitude like you were going to go get it, like you were going to go do something and really make something, and everyone around you seemed like they wanted to follow your lead because you seemed like you knew where you wanted to go. And I think that 10 years later, you're a partner in one of the top venture capital firms. I think that judge of character can be really important. So like, how do you mitigate that risk in that case?
So I would love to incorporate that into our process, and we are collecting founder data, but we're not yet using it to make decisions because we don't have training data. Like there's a lot of, if we were to say, oh, well, let's look at all of the unicorn exits and then, use that as our training data set. Well, then the next genre of founders would look a lot like our unicorn CEOs today, who are mostly white men in Silicon Valley and New York. And so, we are tracking this, and when we do start to see a signal, we will use it. But today, if I were to say like, oh, well, they went to Stanford +1, like that's my bias, And so yeah, it's you need to start somewhere, and I think founder is important, but I actually don't think founder team is more important than market or the product. And as an operator, an advisor for many years, and now an investor, I've seen amazing teams not make it and fail. And at the same time, I've admittedly seen some mediocre teams stumble into success. And so that's where I think there's always certain scenarios and times, if you're gonna fund deep tech and you're gonna dig into someone's research and expertise and what they, did their PhD in or whatever, that makes sense. But for a lot of consumer and SaaS and marketplace and fintech companies, if you look at the data and it falls in the top, low single-digit % of everything you've seen before. Even if you aren't that impressed by the founder, they might be onto something.
So you've only been doing this for 7 months. Usually it takes at least 7 years for a whole startup cycle to really tell how something is done. And that time period is even extending now. We're seeing companies staying private for 10 years and raising billions of dollars. But maybe you could just say, like, how do you think those startups are doing now? Looking back, do you think that your criteria has been accurate, and have you like made any learnings that have led you to change the model?
Yeah. So as for how we're doing, you're right in that it takes 7 years to get returns data. I mean, there's plenty of, you know, given our sort of the stage and investment size we're currently playing in with capital as a service, we end up looking a lot like a pre-seed or seed fund. There's plenty of pre-seed or seed funds here that are on their second, third, whatever fund who have not yet shown returns data. So, and what they're going off of is like markups and acquisitions and stuff like that. And from that perspective, the capital as a service portfolio, I think, you know, looks very much like it is able to compete with traditional seed funds. I think our companies, you know, we don't make bets pre-launch. Historically, we haven't. We probably are going to start experimenting with that with some of the learnings we've learned from taking founder data. But to date, it's been mostly post-launch. So, you know, there are some things that we will miss because someone can fundraise, they have a reputation to be able to fundraise pre-launch, and then they do well, and then we kind of miss that. But I think in terms of relative to the basket of venture-backed companies around here, the CAS companies are probably closer to profitability because in a lot of these markets you have to be. You don't have access to the capital. They're a lot more capital, you know, along with that, they're a lot more capital efficient. And as for sort of learnings, we've learned a lot. We've definitely made some mistakes. The binary decision whether to invest or not, first of all, it doesn't need to be a binary decision. You could imagine a world where it's sort of like real estate, and at a given price, like anything will clear. We tend to still focus on the top low single-digit percent. And so for us, it is currently a binary decision. That's the easy part. The hard part is actually the deal dynamics, and that's where I, as a human investor, get involved. And there have been a number of times where sort of machine and human have disagreed. So there was a SaaS company in Canada, and they were not able to fundraise. And so they came, they heard about capital as a service, I don't remember how, and they applied sort of in the midst of fundraising. And so I looked at the data, I thought, okay, this looks good, we should invest. And at that point in time, even though I had the investment decision, I would still talk, this is the early days, so I'd still talk to every founder and then, make sure nothing was too crazy before committing.
You want your founders to be like enthusiastic,
it's a real
enthusiastic like cult members, not like cult leaders.
Not like a bot or something. So I remember talking to this guy, and he was very honest. Like, we just can't fundraise. Like, there aren't a lot of VCs where the company is based, and people here weren't interested in funding a company where they're based. And so basically the human in me, the human investor, was like, run. This company's never going to be able to raise more capital. They don't have a path to profitability. But then that really went against what the whole purpose of CAS is, which is this should be a meritocracy. And if you build a product that customers use and they get value, and in the case of their business model, pay money for it, and it looks really good relative to all the other SaaS companies we've seen, which are a lot, then they deserve funding. And so we went ahead and we made a $50K investment, and I'm pretty sure that without that investment, this company would not be around today, and instead it got them what they needed to be able to get enough traction to actually raise a Series A. So that's an example of where we kind of went on a limb and things worked well. To kind of balance that, there was one company where we decided, again, binary decision to invest was a yes. They were based in a Latin American country, and they sent me and so I kind of got on the phone, and this is where, like, we don't have nearly enough data to price well. We will, but even today, it's still hard in many markets. And so this is one of our first deals in this country. And so the founder was like, okay, well, how about this type of note? And I'm okay. And then like a $2 million cap. And I was like, me. Around here, like, you don't even see $2 million caps. So I was like, okay, sure. And so then they applied to sort of an accelerator program, and then I get a call from the head of the accelerator that's like, WTF are you doing? Like, this should have been like a 600K cap. And I was like, that even, like, who's ever even heard of a 600K cap, right? And so that's where, like, I took a big step back at that point, because we don't want to do any harm in this ecosystem. We don't want to go in and like overprice, like, you know, a bunch of deals and make it hard for companies to fundraise. I was thinking more SoftBank.
SoftBank is the new winner in that space. Yeah, they've never won a vision.
I don't want us to be the SoftBank in the seed stage. So, so we really backed off of like, all right, let's partner with local investors who know the market and like try to come up with something that makes sense. And it's really hard to balance that when, because of our process, we're typically the first one that says, yeah, we're in. So yeah, a lot of learnings, mostly around like deal dynamics and pricing.
I'll definitely be fascinated to see if down the line you're guys in the place where like, wow, we were right. This team, like traction is doing great, product's doing awesome. Maybe we should have interviewed that team, because we are definitely going to try to replace the CEO. So we'll see how that goes down the line. So I want to talk a little bit more tactically for some of the founders in the room about some of the awesome things that you've seen, some of the pitfalls you've seen, to give them a little bit of a leg up as they're coming out of the Borderless Summit and looking to raise some money. So let's talk about the tips. You know, beyond the basic, you know, the big idea, having a solid story, having strong metrics, what are some of the best tactics that you've seen founders use to convince VCs to fund them, especially some that might have been like right on the edge of fundability?
Yeah. So one thing that works well for me, and both, I mean, this would work for more of someone coming inbound, but I also do a lot of outbound, is I spend a lot of time talking to our portfolios and saying like, oh, you know, I'll talk to all of the VPs of sales and say, hey, you know, like, what are you seeing in the market? What tools are you using? Da, da, da. So if you can get one of the VC's portfolio companies on board as a customer or a pilot or a reference, that can be a really good, you know, it's someone they already trust. And if they can provide that warm intro I was talking about, that can be helpful. So that can be a really good tactic. Aside from that, this is obvious, I feel like everyone says it, but, you know, be pretty targeted in who you talk to. You know, every once in a while someone will, an entrepreneur will reach out to me and I'm just like, oh, like, I don't know, what do I know nothing about? Like, ag tech, and I'm just like, I haven't even been to a farm. Like, I don't know how to go there. I'm just like, so you know, whereas if someone's like, oh, hey, I saw that you worked at SurveyMonkey and Optimizely and DocuSign, and we're also a B2B SaaS company and would love your opinion, like that, I feel a lot more like, okay, they aren't just spraying and praying across all the investors. They actually think that there's something, like, you know, unique about our potential relationship. So that's what's helpful.
Yeah, that's a big recommendation I have for founders when they're pitching press as well. It's like, find the person who's going to be your champion, because they care about that space already. Because whether it's a partner who's going to have to be the one that recommends you to their other partners and gets you that full partnership meeting, or you're talking to press and you're trying to find that person who is already an expertise in this, isn't going to have to learn a whole bunch and actually is going to be able to write something deeper than just like, they raised X money. Like, it's really important.
Yeah.
So on the other side, what are some pitfalls that you've seen startups fall into that convinced you that you or maybe other VCs that an otherwise attractive business wasn't worth funding?
Yeah, the biggest thing, and I mean for me, and this probably all of my partners would agree with this, but occasionally we'll come across a company that doesn't want to disclose a lot. So, I mean, it could be, you know, little things like a non-science, you know, just like an application layer software company asking you to sign an NDA, and it's like, okay, really? Or like, oh, we don't want to give you our metrics, and like anything that seems like there's something that they're trying to hide, or lack of transparency is always a really big red flag, especially because we do really want to go deep on the metrics, and part of that is that it's for our diligence, but another part of it is that is one way in which we prove our value to entrepreneurs. I mean, we've had companies come and go through our diligence process and we've not funded them, and then, we come to find out that they're still looking at their data in the way that we looked at their data. By the time they raise their next round, they come back to us. And so it really is a two-way. It doesn't benefit anyone to withhold information. And particularly even if you do end up getting funding and then you're, unveiling whatever mess at the first board meeting, that's not going to go over well.
Yeah, I feel like when you don't disclose any of that stuff, what you're really saying is that, like, we think we aren't great executors, we just have this awesome idea, and if anybody else had the idea, they'd be able to do it better than me. It's like, I want the opposite in a startup. I want it to be like, I don't care who knows our thing, they're never going to do it as well as us, because we have the right team, the right approach, the right passion for it.
Well, and stuff goes wrong all the time. Like, everyone has the feature that flopped, or even product that flopped, or soft period, or messed up acquisition marketing for a quarter or something. And it's just it means so much, like, startups are gonna hit those road bumps, so if you can see how they deal with them in advance, and instead of it being like, oh, we're trying to hide or be defensive, it's more, oh, hey, we did this and we learned this. Like, that seeing that sort of like internalization of feedback is way more valuable than, obfuscating.
Then finally, for international startups who are coming to Silicon Valley and trying to raise money here, any specific tips that you found helpful for those kind of founders?
Yeah, so be really careful to not, like, I know it's tempting to optimize for valuation, but know your home market and don't get over your ski tips on valuation. And I've seen this a lot with capital as a service. Companies will come here, they'll fundraise here, and I was one of them, like, oh, 2 million cap, like, sure, that sounds like totally reasonable. And then with that company, we ended up like smoothing it out with the incubator and like coming up with something that worked with everyone. But I mean, if you are at multiples more valuation than you should be for your market, then it's just going to make it all the harder down the road. And unfortunately, a lot of these Silicon Valley companies who will, participate in these, more like syndicated rounds are not interested in following on later on. And so you are going to have to go back to your local market unless you completely move here, probably have customers here, etc.
Right, it's like if you raise it too high of a valuation and you don't have the metrics to be able to justify an improvement in that valuation for your next round, you're suddenly going to have everyone say, I mean, you raised at a $2 million cap, I think you're worth maybe 2 million, maybe 1.5 now, and all of a sudden that death spiral starts where it's like, oh, you guys raised a down round, we don't want to be a part of it, and, team members leave, partners are weary, and it just all starts to go downhill. So definitely be really careful of that. So just to overall summarize some of the awesome insights we got from Ashley, there's not too much capital. It's really that it's just not evenly distributed to the amazing founders of diverse backgrounds, whether that's women, different races, different origins, sexual identities. There are so many incredible founders that are a bargain to invest in right now. But really, you still need to be focusing on the product over the team in a lot of cases, because the team can change, the product can change too, but if you have something that's really working and the metrics show it, like, you guys are going to be able to build a team that makes that get to the next stage. And we're really trying to build something that is closer to the meritocracy that Silicon Valley promises, but is not really quite like right now. You still are always going to need that human instinct and intuition when you're vetting these startups, because some people just have red flags in them that you're not going to see in the business metrics. But I think overall, if you're trying to figure out how to vet those companies, especially internationally, you got to partner locally and find people who know that space and know what the contextualized valuation should be. But then again, if you're trying to raise money, if you're on the founder side, getting a VC's portfolio company as a client or a partner, or at the very least a referral, can be a great way to get a yes from a VC. Target the right partner that actually invests in your space. be sure that you are comfortable disclosing your metrics, your business plan, because no one's going to steal your idea unless they can execute better than you. So show that you're a winner with the execution, not just the idea, and that you can conquer the obstacles that come up, because there's going to be tons of them. So rather than trying to downplay your competitors or downplay your threats, just explain how you're actually going to surmount them. And overall, just be sure you never get over your skis. Take the valuation that's appropriate, not just for now, but for what you can build on in your future rounds. And you're going to be able to build one of those companies that we can point to and say, yes, Silicon Valley is a meritocracy. So thank you, Ashley, for talking with us, and thank you guys all for coming to Borderless Summit.